Welcome everyone to Tax Power Hour. Today is November 7th, 2018, and today's episode is Qualified Business Income Deduction for Partnerships, S Corps, and sole proprietors. We'll spend about 5 minutes just quickly talking about Tax Power Hour. We'll do a quick introduction to set the whole thing up, the concept between the tax reform with the 21% new flat tax rate versus pass-through entities or self-employed. And then we're going to give it over to Chris. He's got a really awesome presentation on probably one of the most confusing and most important changes in the tax code for this upcoming year, which is the one that affects S corporations, partnerships, LLC partnerships, that sort of thing, and sole proprietors. And then we'll leave it 5 minutes more or less for Q&A. So real quick, Tax Power Hour is a webinar series that I created. It's supposed to go every month, but sometimes we go a couple months without doing it. But the registration link is on the screen. If you are watching the recording afterwards in YouTube, you can use that link to register and watch the future ones. And we would love to get even more activity in the Facebook group. We have a Facebook group with about 700 people. We'd like to get more activity to just continue the conversation on tax related topics. Just go to facebook.com, search Tax Power Hour, and you will see it. This is not a CPA based webinar, so we will not have polling questions interrupting the webinar. We're just going to go and we'll ask maybe a polling question at the end just to get an idea for whether or not you liked the content. And mostly we're going to be talking about tax, and for the most part, we're probably going to go an hour. Okay, that's the goal, but it doesn't have to be a hard hour. If we finish earlier, we finish earlier. About me, my name is Hector Garcia. I'm a CPA and a tax professional based out of Miami, Florida. My email is hector@garciacpa.com. If you have any tax questions, QuickBooks accounting questions, I'm pretty accessible. And as long as the questions are short enough, I can answer them. And then Chris, my friend Chris, is a CPA as well. I believe he's based out of Minnesota. I'll let him correct me if I'm wrong, but he's got an office in
I'm
South
at
Florida.
the Minnesota offices today.
Yeah, Minnesota. You have an office in South Florida as well. And you want to check out Halon Tax. That's Chris's brainchild. It's you
Those are the
understand
offices
exactly.
I'm at right now. This is Halon Tax behind me.
Halon Tax. Can you describe Halon Tax for us real quick, maybe in a better way that I
can? So Halon's been is a software application that is kind of like an online accounting firm that has been in development for about 3 years. It launches on the App Store, the QuickBooks App Store, this January, and is really a efficient, affordable solution for tax return preparation for small business owners. So we do S corporation partnership tax returns as well as personal tax returns.
So a Halon Tax in scale will either be competing with accountants, or you have an area, you have a version of it as wholesale for accountants as well.
We have both. So we have a version for small business owners, which on its head would probably be competitive, but we also have a program for accountants that get a wholesale service that's a much lower price point, and they can actually use Halon and then provide that product to their clients and bill whatever they want to for it.
Awesome. And Tax Planner Pro, it's software, 100% software that connects to QuickBooks Online, gets the data, and allows you to create reports and plans throughout the year for tax planning. So it's a really great tax planning tool for those folks that are maybe not even tax professionals that don't have the sophisticated tax software. They can get Tax Planner Pro, which is really sophisticated at this point. Before it was just supposed to be a quick app, but it's become this really big, it's almost become a tax software in itself, but it can calculate what if analysis and stuff like that. So check out Tax Planner Pro. Okay, so let me introduce this first by, so everybody, let's call the tax reform a pure marketing politics move. From my perspective, let's call it that. And what ends up happening is you get a very simplified message like, we lowered the tax bracket from 35% to 21%. And that's what you hear. If you're not deep into the tax world, that's the blurb that you hear, right? That's the messaging from
and lots of people will say, well, I'm gonna convert all my clients to C corporations because the tax rate's been lower, and that's kind of a thing too.
And we want to debunk that. That's what we want to do. So, but conceptually, if you were to use simple math that most small business owners will understand, you can say, look, if you take a C corp, with a net income of $250,000 and you multiply it times 21%, that's $52,000. If you take the actual progressive tax bracket that we have for an individual making the exact same amount as a sole proprietor, as a self-employed individual, just contrasting the two, that person would actually be paying $63,000, and this could be the exact same business, right? It's just a different entity. So the challenge that we have is that while the marketing message is, hey, we lower taxes from 35% to 21%, the applicable that doesn't apply to everyone under every circumstance. And there's a huge gap between the personal income tax decrease, which wasn't as deep as the corporate income tax decrease, and this section of the law, section 199A, was actually designed to bridge that gap. And it's kind of a Coca-Cola formula. It's got a whole bunch of moving parts, but it is there mechanically to get to probably closer to that 21% across the board through all businesses, so you don't penalize S corps, partnerships, sole proprietors that don't have a C corp, and also it makes no sense to have people just changing entities around just for the purpose of lowering your taxes or avoiding taxes, and the government, you know, they want to get paid, but they also create mechanisms for you to structure things in a certain way. So Chris has always been a proponent of S corps. We did an hour and a half episode last year where we did a really deep dive on that. I recommend you still watch it. It's still relevant, even though some of the parts have changed. But we're going to focus just on that section 199A. And I'm going to plug one thing. A really cool tool that he has on the Hail on Tax website is sbadvisor.hailontax.com. If you click on that link, and let me pull it over real quick, see what it looks like. So if you click on that link, the website looks like this. This is not meant for tax professionals to get all the details about what's taxable and what's not. This is really for small business owners that are trying to just get a quick guidance in terms of, what legal entity makes sense for me depending on the dollar amount of projected income. So you go ahead and pick the type of business. You put it's a construction business. And this stuff is only relevant if you pick one that wouldn't qualify for Section 199A. Otherwise, this is not really that important for most people. But then we type of business, and you pick the type. I'm going to pick LLC because that one can actually be anything. And then I'm going to pick one owner just to simplify things here. And I'm going to put here that the gross profit or the net profit is 250,000. And then I'm simply just going to click on create report. And it's going to get a quick report. Again, that's going to do it just a quick rough and dirty to go, okay, if this was an S corp and you were paying yourself a portion of that as payroll, and all that stuff is pre-built in there, all the payroll taxes, that would be roughly the tax. If you're a sole prop and really there's no payroll, but the entire amount is subject to self-employment tax, that's what it would be. And then if you're a C corp, you're probably going to have to do some payroll and some distributions or dividends, and that's what the calculation does. So this actually it's really neat because it just quickly proves or disproves that the S corp, most accountants would agree, the S corp is almost always the best entity of choice. So check out the tool, and this is based on the Tax Planner Pro engine. So this is the type of stuff that the Tax Planner Pro software gives you, but this is like the really simple version for small business owners.
I'll tell you why I built it. I meant it as a way that small business owners could take a look at this information, right? But I also wanted something that even in my practice, I could just grab, especially if a client was like, well, quantify what you're talking about. I can run this really quick and I can show them very kind of broad strokes of how to compare how these taxes work. And of course, if you want to get super, super detailed, you can use a product like Tax Planner Pro. It will become, you can enter all kinds of variables in there. But this is the kind of way that, or kind of an idea where small business owners are. They're like, just give me the high level, man. I pay you to do the work. Just give me the high level notes. And the high level is, in most cases, the S corporation's best.
And you got the pros and cons, like, you're going to have some savings on self-employment tax, but you have to have payroll, like just simple messaging, right? You have a limitation of how many owners. Okay, so that's neat. So that's the only thing I wanted to show and plug, because I think it's really good that you build that, because even for accounting professionals, it's a really good quick tool to have. Yeah. So Chris, I'm gonna stop talking until you ask me to. I'm going to go ahead and give you full control,
Sure.
make presenter, and you can do your presentation. I just did this presentation with him. I saw him do it, and I think it's fantastic. I think it covers all the bases. But we'll see if we have any folks asking questions on the fly. So go ahead, Chris, take it away.
Let me take a look and make sure that you guys can see my screen the way I want you to, and it looks like you can. So I'm going to get started here. So today, let me move some things out of the way. Today's all about Section 199A, and if you're an accountant, you have heard about this quite a bit. It's been going on since the beginning of the year. But for a small business owner, if this is the first time you've seen or heard about this, this is a presentation that I really tried to design where I could take you through it step by step, and you could understand really, again, the high level of it. Because one of the most important pieces of Section 199A is this is what I would call a free deduction. Most of the time, we are required to spend money in order to save on our taxes, whether that be depreciation, whether that be through expense acceleration, even spending money by putting it into a 401k is moving money in some way. But the 199A isn't like that. It is something that you get just for having run your business. It's just a calculation. And that makes it a lot of fun, frankly, because I think you're going to see a tax bill that's much different than what you had last year. So let's kind of jump into it. Let's get into some of the information. And first, let's, kind of the disclaimer side of things. Hector, I think my staff saw you do this in your presentations. And so they said, if Hector's doing it, it must be absolutely the best practices. Disclaimer here, we are not providing legal advice. I'm a CPA as well. And I can provide tax advice if I want to, but you really should, if your situation is different than what the situations we're providing here, go get your own professional to work on it, and that's really best practices too. So here's a quick rundown of kind of what we're going to talk about, what we're going to go over. We're going to start with a little bit of background information for those who haven't had a lot of exposure to the 199A deduction. We're going to quickly go through something called qualified business income, which is the income that this deduction is based on. Then we're going to go into how the deduction is calculated, and I'm going to take a look at a couple of scenarios. We're going to have lots of examples, and we're also going to dive into something called the specified service business, or the SSB. And just to touch on that, specified service businesses are where this deduction kind of hits a roadblock, right? Where if there's certain businesses that if they make too much money, they're going to have either a phase out that they have to work through, and then specified service businesses aren't going to get the deduction at all above a certain threshold. So we're going to get into all of that. From there, we're going to talk about some of the advantages of different entities. And as Hector kind of previewed, S Corporation, even with the new 199A, even with the 21%, corporate tax rate, I'm going to show you some examples where I think S Corporation still generally wins. So that is our agenda. Let's get into first what is the 199A. And as Hector alluded to, it was created as part of the Tax Cuts and Jobs Act. And the reason for it was they were giving this huge tax cut to corporations, to C corporations. And when they did that, they realized they were leaving out all of these small business owners, which was a massive part of not only their voting bloc, but of the tax-paying community. And they said, well, what are we going to do about them? And they came up with this super kind of, what I would say is a complex way of doing it, where they probably could have just lowered the tax rates for small business owners, pass-through entities too, but they didn't do that. Instead, they did this deduction. So it was a way to kind of balance the playing field, a way to kind of level it, I should say. In the best case scenarios, you will receive a 20% deduction on the qualified business income that you have coming out of your business. That is what this is. It's a 20% deduction on whatever your income was once we calculate it a certain way. And as I said, there's income limitations. There are entities that won't be able to take advantage of it, but this is primarily for sole proprietorships, partnerships, S corporations. Okay. Now, 199A also is allowed for some other entities, trusts specifically, that kind of thing, but we're not going to talk about that today. C corporations do not get the deduction because this was to offset what the C corps were getting in the new tax law. Make sense? So in order to really get a feel for the benefit, we have to understand this new concept called qualified business income, or you'll hear me call it QBI. The regulations state that it is the net amount of qualified items of income, gain, deduction, and loss with respect to any trade or business. In other words, and to kind of simplify this a little bit, it's the net business income. It's the profit, really, in very simple terms. And in most businesses, it's going to be profit that this is calculated on. There are a few things that have to be factored beyond that. I'm simplifying it a little bit, but most business owners, 99% of them, we could say, are going to have QBI that equals their business profit. That makes sense, Hector? Anything you want to add there?
I was muted.
Right.
Sorry.
Yeah, no,
yeah. Now we're good to go. I mean, I think you mentioned best case scenario, you get the 20%. Worst case scenario, you get none of it. And then there's the calculation in between, which you're going to do an example for.
That's right. Several. Yeah. Very good. So, for businesses in calculating the deduction, lower incomes, as the slide says, is going to enjoy this full 20% deduction. Okay. Higher earners are going to be the ones that have to possibly calculate whether they get phased out of it or not. When incomes exceed the phase-in amounts, and on the slide, you can see it here, single, this is an important set of numbers here. If you're single, 157,500. If you're married, 315,000. Now, what am I talking about? This is your taxable income, okay? Not your business income. Don't get the limits confused with what your business makes, because the limitations don't actually care what your business made in some way. What it cares about is what your total taxable income is before the deduction. So if you're single and you make less than $157,500, you don't have to worry about the limitations. In the same way, if you make $315,000 and you're married, if you make less than that, you don't have to worry about some of these phase out amounts. Now, I go into on the slide the range of the phase outs. So the phase outs go, if you're single, from 157.5 up to 207.5, and then from 315 to 415 if you're married. This also means, and I know we've got a lot of accountants, 60%, 63%, right, of you are tax preparers. You are a specified service business, which I'm going to get into here in a second. But if you make less, if there's one thing I want you to take away from this, if you make less than 157,000 if you're single and 315,000 if you're married, you don't have to worry about it. You still get the deduction. You still get the deduction. Case closed. Okay. If you make more than that, then you're going to have to forego it if it's in the above the phase out ranges, which is 415 and 207,500. If you're between those amounts, and I'm going to show you here in a second, you get something, even if you're a specified service business, but you don't get all of it. Okay. So, and
there's a question here, Chris. This is combined income. So if you have, let's say, a spouse that has a W-2 of 100,000, and then they have, let's say, under 300 on the K1 for the S corp, is the combined income of the two that will phase them out, correct?
That's right. Taxable income, whenever you're dealing with a married 1040, right? Taxable income is only one number. It's the combination of both. If you're single, it's still, it's probably just your income, of course, right? But we're talking about if you have a high earning spouse. And here's really, and this is opinion now, they were really trying to get at, they wanted to make sure that they had a snippet for the media that said, we are not giving this to the top 1% of earners. That's really, I think, why they said it here. Because if you look at the top 1% of earners in this country, it's these ranges. The top 1%, I think, is very close to earning 415,000 or over. So they wanted to have that soundbite where they could say, we're not giving it to the wealthy. So if you're a specified service business, you really got to watch those phase out ranges. If you're not, then I'm going to show you where some of these calculations, where you still can get it, but you have to jump through some hoops. Example. So here's a first example of kind of how this works. So I'm going to read a little bit about this. So John is married, operates an online store. He and his wife's income is solely from the business. So that is each of their only income, kind of a simple version, but they made $200,000 in 2018. Since they're under the married filing joint amount of $315,000, they will be able to take this deduction. Okay, so they're able to take it. Now, after taking their standard deduction, the deduction is actually 20% of their taxable income. And so here is something that will become very confusing, especially to practitioners and to small business owners. And it's the first major point I want to make. The calculation is 20% of the lower of your business income, your QBI, or your taxable income. And in many cases, if the business is your only income, your taxable income is going to be the lower of it, because you're going to have standard deduction or you're going to have itemized deductions that come off of that number. Now, is the difference between that going to change your habits? Probably not. If you just know that you make $200,000 and you're going to get a 20% deduction, and you calculate generally what that is and make business decisions based on that, it's probably not that big a deal. But from a practitioner's perspective, just know that as you're trying to kind of give clients an idea of this, always be thinking it's the lower. And in many cases, especially at Tax Planner Pro, and as I've run tax projections and helped other accountants with tax projections, I'm finding that in most cases, it is that taxable income number we're taking the 20% of for the deduction, because many business owners, that's their sole income source. So again, here's the calculation, a very simple example of it. I'm going to show you the same thing now as we presented in Tax Planner Pro. So here's a way to kind of look at it as it looks like on the tax return. So you can see it starts with the business income up here at $200,000. We've got the itemized deductions, which is actually the standard deduction of $24,000. The pass-through deduction is $35,200, which is the 20% of the taxable income, and then the taxable income's here, and what the tax due on that is if they hadn't paid anything. This example is kind of like if you live in Florida, so there's no state tax. Okay, makes sense? Again, the message should be, this is really good. This is the first time that I can remember in practicing for 20 years where we have a deduction for basically doing nothing. It's like an exemption, right? You just have to exist, or you have to live to get it. Let's go on. Let's take a look at another one. So let's start looking at these phase out ranges a little bit. So for those above the phase out range, okay, the 157 or the 315, the deduction is calculated taking the lesser of the 20% of the business income or the greater of 50% of the W-2 wages, or 25% of the W-2 wages and 2.5% of the UBIA, which is unadjusted business assets right after they've been purchased. So in a lot of ways, you can call UBIA the cost basis of your assets. And for most people, that's what it's going to be. It's going to be the cost of whatever that asset was. Now, again, this is opinion. Here's where the Congress really got kind of off the rails here, I think, because this is just a very complicated calculation trying to get at something which is very simple. They don't want people taking this deduction unless they're paying wages. And the wages are important because they wanted to increase employment. They didn't want people who make $2 million on their own getting this deduction. They wanted you to have to spend some money on W-2 wages. Well, in doing this, they've kind of complicated it up. But let's take a look at an example using these, this filter we have to go through now of these wages and see what it looks like. So here's another example showing a married joint filer whose income is $500,000 in 2018. They also paid $50,000 in W-2 wages to some employees in 2018. Now, at $500,000, their income is above the phase-out range, right? So they're married filing joint, but the phase-out range is from 315 to 415. So they've actually gone completely out of the phase-out range of $500,000. So here's how you calculate the deduction. Their 20% deduction is equal to the lesser of their QBI times 20%, or the wage test. In this case, the wage test is what they're going to have to go off of, because their full 20% deduction, as you can see on the screen, is $95,200. That's what they would have if they were under the phase out limit. But because they're over it, we now have to look at the wages, and their wages were only $50,000. And in this example, we'll say they don't have any assets. So it's 25,000 times, the 20%. So 50% of the W-2 wages is 25 grand. Therefore, they're allowed a $25,000 deduction. A huge decrease because they didn't run enough wages. So from a planning perspective, the issue really is, if someone is earning a lot of money, to take advantage of the QBI, they have to make sure that they're paying out quite a bit in W-2 earnings, or they have significant asset holdings. And here, I'll show you another example. This is another example inside Tax Planner Pro, and you can see 500,000. Here's their itemized deductions, but their pass-through deductions only 25,000, because 50% of 50,000 in wages is what they were limited to. If they didn't have to run across that limit, again, it would have been more like $95,000. So they were limited quite a bit in the deduction. Is that all being clear, Hector? Is there anything else I should touch on in that?
Yes. No. The only thing I would touch on is that you're not gonna go pay your employees more to get the deduction, that sort of thing. But some people
No.
can. Some people can. And I wouldn't see like if you're tax planning and you're debating whether to give an employee a $5,000 bonus or not, and that person deserves it, and this gets you over the hump, I guess that would be a good thing. But I think it's just important to mention that you're eventually going to tweak the owner's W-2. So it's not going to really decrease or increase anything in terms of it's just moving money from right pocket to left pocket. Arguable, you still have to pay the payroll taxes, but you can still kind of game this, not game it, but you can choose what to give the owners a higher salary. The IRS usually doesn't gripe about that. They usually complain
Well,
about
I
paying
think
too
what this
little.
is going to do is incentivize people to get compliant on their S corps.
That's right.
Right. Because that's always the issue with S corporations, is no one's wanting to run payroll because they're wanting to be, awfully piggy about saving on the self-employment tax. And this is actually going to make them say to them, I think we're going to see it across the board where people say, no, I do need to run the right kind of wages, because otherwise I'm not, kind of gaming this calculation the right way. Now, like you said, I'm never a huge proponent of, hey, spend money just to get a tax deduction. I don't think, there should be a good business reason, right?
I was gonna say there was a follow-up question to that. I wanted to make sure I didn't forget it. Is the W-2s you're talking about are the wages paid by the company, not the combined W-2s we were speaking about earlier that has to do with the phase out. All right, this has to do with the limits. This is the limit, which is different than the phase out.
That's right. That's right. And I can tell you, as someone who makes tax software, the phase out calculation, which we're about to start to get into here in a minute, and I'll preface it with this: you should not be trying to do the phase out calculations by hand or in your head, because especially on a specified service business. But either way, if it's a non-specified service business or a specified service business, the phase out calculations are wicked. They are tricky. And having software handy that can do that is highly recommended, because as you're having conversations with people between now and the end of the year, and this is for the tax practitioners watching, and really for the small business owners too, I hope you're doing tax planning at this time. You want to make sure that if you're in those phase out ranges, that you've got a piece of software that's calculating that right for you, because it can get very counterintuitive if you try and do it by hand or just kind of in your head based on what you know that the general calculations are. So let me keep going here. So another term that we're just talking about here that we have to get to know is the specified service business. And these businesses were targeted by the law so that deductions could be limited after they make a certain amount. And they're really targeted because I think, again, Congress didn't want a soundbite where, not to pick on LeBron James, but where LeBron James gets an extra 20% deduction because of the new tax law. They didn't want that out there. And so they started looking at who the individual high earners are, and they're talking about actors, they're talking about people who compete in sports, but they're also talking about professionals, accountants, lawyers. These fields include things like, as I said, it includes law, it includes accounting, actuarial sciences, performing arts, there's brokerage services. There was kind of a weird, it shows you how impactful lobbying can be. The architects and engineers were at kind of the 9th hour, or at the 11th hour really, were exempted from this specified service piece. So if you're in the business of engineering or architecture, you're not a specified service business. But to me, there's no reason for that other than some lobby got in there and won that concession. And the final field includes, the final field on the slide includes trades where reputation or skill are one of the, that the business relies on the reputation or skill of the owner or one of the employees. And again, every bit of research and discussion that I've seen, whether it come out of the IRS or whether it be amongst practitioners trying to figure out a set of principles to teach everyone else, this is where the difficult part of the law is going to exist, because there's going to be lots of folks who want to challenge this idea that they are a specified service business. And I have no idea how the IRS is actually going to try and litigate and police some of that. I would recommend that if you think you're a specified service business, at least for this year, that you abide by a very conservative set of filings. Meaning that if you think you're a specified service business and you think you're over the limit, I would probably avoid the QBI deduction, because I think the penalties and the enforcement could be severe. This could be a very easy thing for them to prove if they had to, I think, for several businesses. But the specified service trader business, here's why it's important. Because if you are a specified service trader business and you are over these thresholds, so if you're over 207,500, that was the end of the threshold for single, and you're over 415,000 for married filing joint, you don't get it at all. The deduction's gone. So that's not good news. And really, it's one of those things where we have to make sure as practitioners and as small business owners that we understand that part of the law, because it's disappointing and will affect tax rates and tax dues quite a bit. Let's, kind of keep going on this. So for any business that's under 157,500 and under 315,000, if you're married, it's pretty straightforward. You get the deduction. So I want to make sure this is very clear in this presentation. If you're under these amounts, you don't have to worry about specified service business, okay? Once you get into the phase outs, if you're a specified service business, it very quickly starts going to zero. So if you're in the phase out range, 157 to 207 and then 315 to 415, you still get something, but it starts to phase out very quickly. And by the time you hit 207 or 415, it is at zero. And those who have businesses that are above that amount, you don't get it at all. So here is an SSTB example. Tony makes $150,000, okay? From his S corporation, it's a specified service business. He files a single. Since Tony's under the specified service business threshold, under the entire 199A threshold, he will be entitled the full 20% deduction. And his deduction here is calculated as 150 minus 12,000 in standard deduction. I'll show you right here. He gets a pass-through deduction of 27,600. Again, most of my examples are showing how taxable income is what we calculated it on, because I think it's real easy to take business income times 20%, but I think there's several situations where you're actually going to be doing taxable income times 20%. And that's taxable income before the deduction times, that's the taxable income that we're testing if you qualify for the deduction, I mean. So there's a summary of the SSTB example. Now here's one more where if same Tony, but he makes 250,000. Here, his taxable income is over the 207.5. He is a specified service business. He is single, so he gets nothing. And here is the way that looks in TPP. Again, it's 250. He gets his itemized deductions, but no pass-through deduction, and thus his taxes are higher. How am I doing, Hector? Anything you want to add there?
No, just good to go. I mean, I think an overarching example good to use is you got $2 amounts that you have to keep in your head, right? One is 157, 315. Every business, no matter what it is gonna get the 20% deduction as long as it's under that, right? So under that, you don't have to worry about it at all. Over that, it's gonna be two groups. The the accountants and lawyers and professionals are the SSTV group, and those folks are gonna be completely phased out at, go back for a second, it was like two something and then 415, right? It was like two
That's
something
right.
and four.
So it's all the way back here. So it's 157, the phase out starts, 315, the phase out starts,
Right, so
and then you change
207
it
and
to 207 and
415. So
415.
that's the other number you need to know. So for accounting, for accountants, lawyers, anybody that specified trade or business, 207, 415 will completely phase you out. There's nothing else you need to calculate. You just don't get it. And then the example I think you're about to do next is
Mhm.
for the non-SSTB business, so let's say construction business, manufacturing business, which is what most of these laws are meant for them, right? For creators, job creators, which for you could argue that accountants, lawyers are job creators too, but the ones that contribute to GDP the most. So manufacturers, construction companies, those are the ones that are highlighted usually when all these Congress discussions are back and forth and they're thinking about this construction company that's expanding. So for them, those numbers still apply, but there's a limit on the wages, which you're going to do the example on.
Yeah, and one of the ways that I think about this wage limit is I kind of mentally I separate my clients into two different pools, right? There's those that make under 315 and those that make over. The ones that make under 315, in many ways, I don't really have to do too much with them. I get to just say you get the 20%. I don't have to think about it a whole lot. Of course, I have to watch spousal wages and other income that's coming into the personal tax return. But in general, they just get it. I don't need to worry about it. But this is the time of year, November and December, where if you have clients that you know on their personal tax returns are going to make over that, but they are not specified service businesses, then planning appointments, you should be using this as a way to get them in there for a paid planning appointment. This is not something you give for free. This is not part of the tax service. This should be a part of a planning engagement where you say, okay, let's run the numbers and let's make sure that payroll, that our asset computations, that we are taking advantage of this thing, because you still have 2 months to make changes if there's something that you can change. One of the things, not to get too off track, one of the things that I was really worried about when the laws first came out, and at Tax Planner Pro and at Halon, we were diving into this stuff in January before anybody had really, dove into it with us. Just the tax softwares were trying to get their handle on it. Was if you used a PEO, a service where you would employ your staff through another company, so they're actually employees of another company, and then you paid that company as a vendor, whether they would be able to count their wages as towards the test, because on the face of it, that would actually be wages of that other company, right? And would contribute to their ability to do the 199A, but not to yours, even though you were the one paying them through this company. And the IRS has given guidance on that and said that no, it flows to the wage test flows, and the calculations and those W-2 totals flow to the end user, meaning they flow to the company who was utilizing those employees. So that was a nice development too. It didn't mean that all these PEOs and third-party workforce folks would have to shut down, because I think that would be the end of their business if people can take this deduction if they used them. Let me show you in this next slide. This is another kind of simulation. And I apologize for all the small numbers on it. There's only one way to get all this information on one screen, and that is to cram it into a spreadsheet. But what this is showing is kind of the last point that I want to make as part of the presentation, both to small business owners and to practitioners, is the comparison of what each of these type of entities actually yields from a tax perspective. I have spent the last 6 months at least trying to debunk this idea that the C corporation is now the go-to entity. Now, I will not disagree that there are some situations where the C corporation probably makes sense, especially if you have someone who doesn't really need to take the money out of the C corp right now, so can make $500,000 and leave it all in the business, just pay taxes and leave it all in the business. There's probably situations where that makes sense, but for a typical small business where they need to take the profits that they earn and either distribute them to the shareholders or get them out of the business, I think the C corporation still doesn't meet up to what the S corporation can do. So in this example, I have the same kind of information up at the top. So we've got $500,000 of business income, and then we have assumed some things about wages. We have tried to keep them standardized. Of course, with a C corp with no payroll and a C corporation with payroll, we've tried to show the differences between the two. Sole proprietorships don't have any wages, but we've gone through and calculated everything. Here's what I want you to take a look at. Down here on the bottom, oh, excuse me, let me move this back to full screen here. It won't let me, so I don't want to put my pointer down there. Let me see if this will quit doing that. Go away. Show me see if I can, there. So as you can see down at the bottom, under the sole proprietor column, the first column, total tax is 146. Then for S Corp, it's 123, C Corp, 151, and then over on the far right, C Corp, no payroll, 180. The whole point of this slide here is to show, once again, even at these larger amounts, I can tell you this test works so long as you're running reasonable payroll, but you're not trying to run the whole thing as payroll. And if you do have a situation where you need to run the whole thing as payroll, it wouldn't work, right? But in situations where there's a happy medium, the S corporation does still show a lower amount of tax. So if you're wondering about this, or if you're advising your clients about something other than this kind of entity, I would encourage you to take a look at this and make sure that the scenario matches up with what you're trying to achieve, which I hope is the lowest amount of tax possible. Here, with this example here, and Hector asked me to run one that was 500, because I think 10 months ago, Hector, we ran one that was maybe like a 150, and the results were the same. But here I tried to run the payroll to where it was very close to the Social Security cap, where most of the self-employment tax is being paid. And that S corporation, when you have these kind of numbers, even though the sole proprietorship gets a higher section, 199A deduction, it is clearly a better, kind of a better scenario than with the S corporation is better than with some of the others.
Okay. I have a question for you. I don't know if you've delved into this yet. Rental income, rental real estate. Would that qualify under QBI or not?
Yeah. So there's a very tricky analysis, and this is another one of the areas of QBI and the 199A where I have no idea how the service is actually going to enforce it. So your rental operation has to be, to put it in a very simple way, has to be conducted with the idea that you're going to make a profit. Okay, it can't be, the idea being it can't necessarily be something where you're not really trying to make it a trade or business. If you're trying to make it a trade or business, you're trying to run it for a profit, then the rental situation does qualify. If you're not, and you're holding it as an operation of something else, then it doesn't meet the muster. And there's some kind of complicated discussion about this, even at the highest levels of the Treasury. But my understanding is, and my research is that if you're holding it out to be that, then you can qualify for it and you can get it.
Is there a checkbox for making that election, or is it you're talking about the real estate professional checkbox?
Oh, no, I'm not talking about the real estate. I'm talking about if your rental see, that's why it's a slippery slope. If your rental operation is trying to be a trade or business, and that's very subjective, right? Now, a real estate professional, has always been able to consider their real estate operations, active, and even subject, the losses can go against ordinary income, can go against active income, versus where other users have passive income and they can't necessarily deduct those losses, especially if they make over $150,000 or whatever the limit is. But for QBI purposes, the rental side being able to qualify is based on this idea of if it is a legitimate trade or business. And I think most people are going to say that it is, and I think most people are going to take it here. And of course, if you're not running payroll, you're going to have to rely on the assets, right? The buildings and stuff. And one of the things we read about back in January is that this was part of where the president was lobbying for this, because the president obviously has interest in lots of real estate, and that this needed to be a part of that they could do some of these things if they're real estate owners. And there is some truth to it, right? Like, if you build buildings, you're creating jobs. That's a great way to stimulate the economy. So I think it does get at what the purpose of the bill was too.
And so depreciation is an interesting question, because if you
it's unadjusted basis, So whenever you're talking about those assets.
So I'm not talking about 2.5. I'm talking about,
Oh.
for example, let's say you put some new assets in service this year, and depreciating them normally will just bring you under that hump of let's say that 315, right? So you take a regular depreciation, first year will bring you under the hump. But if you don't depreciate them regularly and your net income goes up, and you take a Section 179 deduction, is the Section 179 deduction part of the calculation of QBI, or is it separate?
So the 179 will reduce the basis afterwards, but I think it is part of it. I'd have to take a look. I haven't delved into that part of it. Because I think 179 is dead. See, I think everybody's going to be taking bonus outside of the real estate side of things.
Right.
And I haven't really taken a hard look at 179.
You're saying people are not going to choose it. Still alive, people are not going to choose it. But in theory, if you look at the K1, the way the K1 is constructed, if QBI is based on the ordinary income that's being passed through, 179 is a separate calculation from that, and it just lowers the how that. So I'm just wondering whether
my gut tells me that you are going to calculate QBI, and I'm almost positive of this. You're going to calculate QBI after the 179.
Right. So whether you choose 179 or bonus, you think it shouldn't be affected.
I absolutely believe that this.
That's what we think, and until we get the guidance in January or February. Okay.
And I'm not saying there's not guidance. This is a 400-page law that, for me, I'm trying to be a real expert in the 95% of users, especially those that use Tax Planner Pro and Halon. And something that's interesting, I think the practitioners on the call would be interested in this. Tax Planner Pro has 8,000 users, and we have a lot of information about those users, right? Only 10%, or it's maybe like 9%, only like 9% of Tax Planner Pro users capitalize any assets at all. And less than 1% of them show any depreciation expense on their books, which means in most cases, I think the law was catching up in some ways to the way that people are already doing their bookkeeping, which is they're expensing a lot of things. They're writing. I'm not saying any of that accounting is correct, but we have a very good cross section of all these retail users that are using QuickBooks and Xero and are in Tax Planner Pro. And assets are not as prevalent an issue whenever you're talking about kind of the micro business, the under $400,000 of revenue type of business, as it would be whenever it goes up. And Halon and Tax Planner Pro, that's their core group, are these small businesses that do under 400 grand.
And under the same sentiment of the Schedule E of the rental income, whether rental income would be QBI or not, and you're saying that you're pretty sure it is QBI eligible.
I do know that it is, so long as it meets the test of a trade or business.
Okay. So, and so if you're a limited partner in a partnership, okay, or in an LLC partnership, if you're a limited partner and you get a K1, but you're not paying self-employment tax because you're a limited partner. Will would the income from that also be eligible for it?
Well, I know that
Passive
REITs
partnership.
are eligible. I know that REITs and publicly traded partnerships are eligible. So I wouldn't understand why, if you were a closely held limited partner, why it wouldn't qualify as well. But I again, not part of probably the wheelhouse that I've specifically researched, just because we don't see it in our business hardly at all. The interesting part about the law in making REITs, real estate investment trusts, and publicly traded partnerships, part of it was, I think they were trying to get at this idea of people can take this deduction if they are a little bit arm's length from the business. I think their intent was trying to make sure that everybody could get this, because I think they also thought that people who were extremely wealthy and using these kind of vehicles could not get the deduction anyways, because they'd phase out of it. So in some ways, at least where I stand, I think that their intent is to try and make this as far-reaching as it possible, so long as you meet the requirements of the phase-out rules, or if you make under $315,000 and $157,000.
And you're showing a draft of a 2018
Yeah.
1040 tax form that has a new line in it.
It has a new line. It's line 9. It's called the Qualified Business Income Deduction. This is part of the postcard 1040. This is what I think be called the back side of the postcard. The front. If for those of you who haven't seen the draft 1040 yet, this is what the new personal tax return looks like. It is smaller and more compact, but the Qualified Business Income Deduction is line 9. And the reason I put this on here is, as you can see, you get this whether you're regardless of some of your other tax situations. So if you don't itemize, if you do itemize, sometimes deductions were based on whether you had enough to throw something on a Schedule A. Well, this is not like that. This is a deduction that you get so long as you qualify for it, and it kind of shows up right at the top of the tax form.
And is there a tax form attached, I guess a new tax form out, like a draft that shows you the mechanics of the calculation and the limits?
So what I have seen so far in drafts, there is nothing in the 1120 or the 1065 that's actually a form calculating it. And from what I've seen, it becomes a footnote to the K1. That's what I've seen. So on the K1, there's a new area on like line 20, I think it is, where there's kind of a footnote on the bottom right of the K1 that shows what the QBI income is. Now that could all change. I think that they were in a real big hurry to get out the 1040 forms. They were a little bit slower about showing the draft 1120S and 1065 forms. And to me, they haven't changed a whole lot. They have changed some, and not based on QBI though. They've changed because they've added some new lines to the Schedule K and done some different things. But they may have some other forms that I've not seen or that are coming out that is going to detail that calculation. I haven't seen it yet. And usually, we make tax software here, but we don't really start trying to take a look at these things until they become finalized. They will finalize the forms to us software developers. They release something on November 1st. We'll parse through it probably by the end of November, and we'll know a whole lot more about it.
Let me run the last polling question real quick, and then you can you want to wrap it up with a summary right after?
Yeah, that sounds good. That sounds good. I've got I think I've got
minute.
this. Yep.
Okay. While that polling question comes up, here is, so they're asking about the W-2 wage limit. So can you explain the W-2 wage limit one more time for those companies over
Right.
the 315?
So if you make over, so I don't keep saying 157 and 315. Let's just talk about married filing joint so that I can just say 315. So if you make between 315 and 415 and you're not a specified service business, you have to, and really anything over 315 in general, you have to start taking a look at the W-2s that you run through your business, your wages. And you have to have at least of those wages that you're going to take the lower. I'm trying to figure out how to say this right where it's simple, but there really is no way to say it. You're going to take the lesser of 20% of your QBI or 20% of or 50% of your wages. I'll put it to you that way. So 20% of your QBI or 50% of your wages. You're taking the lower of that. And this, in my mind, it really means that if you run wages of significantly less than what your net income is, you may have a limitation, right? If you run wages that are much higher in total than your net income of your business, you probably don't have to worry about the limitation. You're probably still going to take 20% of your QBI, of your profit. Is that a simple way to say it? I mean, I think that's how I think about it.
Yeah, that is. So let's go ahead and wrap it up so we can make the final recommendations. And
Sure.
We'll finish
So
up.
again, the big points I wanted to touch on, it's a sizable tax deduction. So be excited about it, be happy about it, be positive about it. We want it to stay around. I don't care what your politics are. We want this to stay around. This helps all business owners. Remember that wages and business income, UBIA, or not business income, business assets are part of the test if you're over this 315,000 for married and 157,500 for single. And this S corporation still, by my opinion, is still the best situation for it. It's something we didn't talk about a lot. If you make over $315,000, you have to have wages, right, to meet this test. But if you're a sole proprietorship, how do you run wages to yourself if you're the only person? You know what I mean? You almost have to be an S corporation if you make over 315, so that you could at least run wages to yourself and qualify for the deduction. So I think there'll be, I don't know how many sole proprietors there are out there that make over 315,000, but I know there's a bunch because the stats from the IRS show that there are. And those folks, I think, are going to need to convert to something like an S corporation so that they can run wages at least to themselves and get this deduction. I still don't think the deduction outweighs the self-employment tax, but if you're making all that, you'd have paid most of the self-employment tax besides the Medicare 2.9% anyways. So you might as well run wages through an S corporation of at least that the Medicare or the Social Security limit, and you'll at least get the QBI deduction, the 199A deduction.
Thank you, Chris. I'll just add one more thing. The most important component, in my opinion, is to get with your clients before the year end, project the total income from all the sources. If it falls into this, if it just falls into the two thresholds, you probably don't need to do anything. Chris would probably argue that if they're not an S corp already, you probably should look into making them an S corp no matter what.
And if they're not an LLC, right? If you've got customers that aren't at least an LLC or something to where they have the choice each year to late elect an S corporation or something like that, you should at the very least be letting those sole proprietorships be, or telling them that they need to be an LLC or some kind of entity based on what your state requirements are. I'm not giving legal advice. Of course, you got to research which state you're talking about, but having that option at year end is going to be really important.
That's right, Chris. So where can they learn more about your software and the things that you're doing?
Tax Planner Pro, which is the tax planning software I produce. And I just want to say, my two softwares are really the only two income tax softwares that are on the QuickBooks App Store. So we're trying to represent all of us income tax preparers and those interested in it in the App Store, and no one's else really gotten into that game. But Tax Planner Pro is already on the App Store at apps.com. And then halontax.com, which is where I'm at today, and it's our much larger offering, that is going to be on the App Store starting in January, and you can refer clients to it. You can use it in your own practice. If you don't do taxes, you can utilize it to be your tax preparer of record. It's CPA signed. It's very, very affordable. So take a look at it. I think you'll be interested.
All right, Chris. Thanks a lot, and thanks everybody for attending. Join the Facebook group. Continue the conversation there. Chris and all the guests that we ever had are members of the group, so you can ask questions there and email me if you have any questions, comments, or concern. Bye, folks.
Take care.